Part 2, 35 minutes. This part consists of 2 independent sections. Investment in Scar LLC. In January 2017, Mufasa Limited acquired an 80% controlling interest, being 80,000 of the issued ordinary share capital of Scar LLC. Scar is a company domiciled in the United States with a functional currency of US dollars. The purchase consideration amounted to $475,000. The acquisition date was 1 January 2017 and the net assets is $500,000. Were audited as being fairly stated in terms of IFRS 3 with the exception of the following. Now guys, important IFRS 3, you know that all of the identifiable assets and liabilities should be at fair value at acquisition date. Right, and immediately we are able to identify that we need to apply our principles of IAS 21. Scar is known to have the best development team responsible for software application design. The development team is the main reason that Mufasa acquired a controlling interest in Scar, and they have determined the fair value of the development team to be $40,000 at acquisition date. Upon further investigation, it was also identified that the fair value of the favorable component of the employment contracts relative to the market was $30,000 at acquisition date. The average employment contract is effective for a 5-year duration at acquisition date. Therefore, immediately, guys, what do you need to identify? That in the separate records of Scar, this is not an intangible asset. But in terms of IFRS 3, in our group records, we may recognize an intangible asset at acquisition date, and we need to remember to amortize this asset based on the 5 years. Now, will we use the 40,000 or the 30,000? We will use the 30,000 in terms of the favorable component, because guys, the unfavorable component, we cannot use that section. Think about this. In terms of recognition, the favorable component has the 5 years contract in place. The 40,000 relates to the fair value of the total development team. But should this business acquisition succeed, we're not guaranteed, guys, that this total 40,000 development team will remain within the entity. Right. The following extract of the audited financial statements were obtained from the auditors of Scar for the year ended 31 December 2018. They provide us with a statement of comprehensive income. We are able to identify for 20.17, 30,000 profit, and for 20.18, a 55,000 profit. They provide us with a statement of changes in equity, a balance at the beginning of the year, and then they indicate to us at the bottom the only reserves as at 1 January 20.17 and 20.18 is retained earnings. Our opening balance is 185,000. We have comprehensive income for the year, the 55,000, which we are able to identify from our statement of comprehensive income, and there's dividends paid on 31 December 20.18. The financial director of Mufasa provided you with the following correct exchange rates. Now guys, they provide us with a rate at acquisition, the average rate, the rate at year-end 2017, the average rate for 20.18, and the year-end rate 20.18. Included in property, plant, and equipment balance of Mufasa is equipment with a carrying amount of 252,000 Rand purchased from Scar on 31 December 20.18, therefore at year end. Remember, this is now our parent, 80% in Scar, and Scar is the seller. If Scar is our seller, we need to include this in our analysis of owner's equity, as there is an unrealized portion included in the profit or loss of Scar, and this will have an effect on our NCI. The fair value of the non-controlling interest on 1 January 20.17 amounted to $125,000. Therefore, guys, this is our fair value. Therefore, we can assume, based on this, that our NCI will be accounted at fair value. At 31 December 2018, Mufasa reduced its shareholding in Scar from 80 to 70%. The shares in Scar were sold for an amount equal to the fair value of the shares. Mufasa Limited did not lose control over Scar at this date. Non-controlling interests were adjusted with an amount of 140,700 as a result of the sale. They indicate to us calculated in accordance with IFRS 1096, not B, paragraph 96. Now remember guys, you need to know this off by heart. When you think about paragraph 96, it indicates to us that there will be a change in your ownership, and this will be recognized in your statement of changes in equity and additional column. How do we calculate this? This will be our NCI before the change, and this will be 20%, and our NCI after the change. After the change, we are looking at 30%. And our consideration, and they indicate to us the consideration is at fair value. Now, important to identify, they indicate here that the non-controlling interests were adjusted with an amount of 140,700. Therefore, we can assume, based on this, that our NCI increased with a 140700, therefore a credit. Queen Lioness Limited. Arriving at the client as a first-year trainee accountant, you are expected to have the highest technical knowledge of all members of the audit team, having most recently completed your CTA qualification at a tertiary academic institution in South Africa. The CFO of Queen Lioness Limited, Whoopi Goldberg, approached you for help with the finalization of some issues. In the introduction meeting between you and Mrs. Goldberg, the following was said. Queen Lioness is jointly controlled by Mr. R. Basney and RB Limited. Mrs. E. Basney, the wife of Mr. R. Basney, has 25% interest in Shenzi Limited, which gives her significant influence over Shenzi Limited. RB Limited's Chief Executive Officer and majority shareholder is Mr. Moyo. Mr. Moyo is also a non-executive director of Sarabi. Mr. R. Basney, whoa guys, quite a lot here, is an executive board member of Kamari Limited, and his brother, Mr. B. Basney, is the CEO of Azizi Limited. Queen Lioness has a 35% interest, and they indicate a significant influence in Kamari Limited, and Kamari Limited has control over Sarafina Limited. Right, therefore let's just ensure that we understand this. Kamari has control over Sarafina. Mrs. Whoopi Goldberg's son, Droopy Goldberg, is one of the directors of Computers Limited, which provides all the computers used by Queen Lioness. Droopy Goldberg has a 65% interest in Computers Limited, which gives him control over the company. All the employees of Azizi and Sarabi Limited are members of the Poly Pension Fund. Right, guys, when we look at this, we can assume this might be a related party question. But let's refer to the requirement. Requirement part 2. Immediately allocate the minutes per section. A, you are allowed to spend 37.5 minutes, and B, 15 minutes. Now, when you refer to the requirement of part 1, you will remember that we have assumed that you start with this question 8 o'clock. Therefore, you will have to complete part 1 by 9:38. When you start with part 2, you will start at 9:38, add 37.5 minutes, 38 minutes, and you need to end with part A, 10:15, and end with a total 10:30. Therefore, guys, when you look at this, a total of 2.5 hours spent to attempt the question. Now, let's have a look at part A. Prepare all the pro forma journal entries required to account for the investment in Scar LLC and the consolidated financial statements of Mufasa Limited for the year ended 31 December 2018. Ignore any taxes. 24 marks and 1 mark in terms of communication skills. Not free, but easy. B. Write a memorandum, therefore remember your format, to Mrs. Whoopi Goldberg, in which you communicate to her the parties that you have identified as related parties to Queen Lioness Limited. Therefore, guys, IS24. For each party identified, provide a reason from the definition of a related party as per IS24. Your answer should comply with a strict interpretation of IS24 related parties. 9 marks and 1 easy mark in terms of communication skills. Comparative figures not required. Round off all your amounts to the nearest rand, and your answer must comply with IFRS. As always, when you attempt section A, please spend a few seconds and briefly plan your attempt.